You might be somebody who already has an operating business and you're currently renting, and you might have outgrew the space, or you no longer want to rent, you want to buy your own facility for obvious reasons. You're wondering, hey, what does that look like, and what exactly do I need to qualify for that kind of financing? So that's what this video is about. Before we get started, please hit that subscribe button, because that's how I'm able to grow my channel. So hopefully you can support me with that, and let me dive in here and get you all this amazing information, right? So when you have a business and you're out there shopping, and now you want to transition into your own facility, they're going to want to see a history of income over the past 3 years, basically looking for stable income. Now I'm going to break it down even further for you so you understand some ratios. As an example, when you're out trying to buy a property, like a residential property, you know that the lender uses anywhere between 45 to 50% of your income. And so they use that against all the other liabilities you have, including the proposed liability, which is the property, right? And so that's a pretty simple breakdown. But when you're looking at a commercial building, they want to see your personal expenses and liabilities, and then they want to see the business income and liabilities. So the underwrite, unlike a residential property, is actually split into two pieces. One is for you personally as the guarantor, and the second piece is for the actual business, its liabilities and its income. Now, they're looked at slightly differently, but then they both come together for a all-inclusive ratio. All right, so let's discuss that. The first thing the lender is going to want from you is 3 years worth of financials. And basically the only reason they need that is they want to see that the business has been stable, or hopefully, the trend of income has been going up. And that makes the lender feel very comfortable about giving you a loan. And the way that they do that is they ask you for your filed tax returns, both yours personally and your business tax returns over the past 3 years. Now you might ask yourself, if they're underwriting my business, why do they care about my personal tax returns? Well, when you look at your personal tax returns, Schedule E of your 1040 tax returns actually has a couple things. One, it has your schedule of real estate. And number two, it also has your schedule of corporations. So if you have more than just the one business that you're proposing to the lender that you want to get a property for, example, you have 4 companies, but 3 of them are just little companies, and then 1 is your main company where you do most of your business, and that's actually the business that you want to get a facility for and you want to get the loan against. All right? If the companies that you're presenting to the lender don't cash flow, which is what's going to be used to support this purchase for this particular location, for this particular business, they need enough income coming from that business to be able to support the proposed debt. Okay? And the ratio is basically 1-to-1. Debt to income, meaning income after expense, 1-to-1. If they're not getting enough income from this particular corporation, as an example, and you have 4 of them, you might find yourself, and again, this is just a hypothetical, having the other corporations having to guarantee the loan, even though they have nothing to do with this transaction, simply because you might have spread your income through 4 corporations. Example, say you have, 40% of your income here in the main corporation, and then you have another 20% here, and now it's 60, right? Another 20, 80, another 20, 100. So that means, 40 is not going to do the trick. You may need 2 other corporations, which will make it 80 to support the debt. So now you got potentially 3 corporations guaranteeing the liability, the debt, the loan. Now, you personally are also a guarantor to getting this loan, right? Because they're going to look at you, because you're ultimately the owner of the corporation. Now, it may be you, and if there's other owners, well, guess what? Like I said, anyone who has more than 25% stake in ownership is going to have to present their financials. Now, when I said keeping it separate, on the personal side, they're going to look at potentially you as an individual with, no matter what you have on your credit report, they're going to use those liabilities in addition to living expenses, which is typically 50 to 60,000. Just throw it into the pot because, you're living, you're existing. And so that, in addition to liabilities you have on your credit report, assuming everything is disclosed, some things may not show up on your credit report. You want to make sure everything is disclosed, together with the liabilities that we said, 1-to-1 with your business, together equal 1.25%. Think about this for just a second. Say I let you borrow $12,000 and you have to pay me $1,000 a month. If I know that you make less than, $1,000 a month, I'm letting you borrow $12,000, you pay me $1,000 a month for the next year, right? If I know that you're making 1-to-1, $1,000 to $1,000, there's not a very good chance that I'm going to get my money back because you're not going to have any money to live. But if you're making $1,250, you have an extra $250 every single month to be able to live. So this is the way the bank looks at it. They want to make sure you're making at least 1.25 and more, It's even better if you make more because, say, I let you borrow $1,000, you make $1,500 a month. Now you pay me back my $1,000, you still have another $500 to live. That's the concept. So when you're looking at a commercial purchase, basically like I said, unlike the residential purchase, those are the two components that come into play. There are other factors involved, but I'm not sure you guys want to get into that. So if you have any questions about any of this stuff, please put it in the comments below. I would love to hear from you. I'm happy to answer any of those questions. If you want to jump on a call with me to discuss a scenario, even better, just shoot me an email. Let me know the context of what you have in mind, transaction, timeline, and then basically what we would do is I will send you a link with basically a breakdown of what we've discussed, 3 years worth of financials that we would analyze. It's called spreads. We would do the spreads. It's an initial underwrite before we actually present it to an underwriter. And what actually happens if you cash flow? Pretty good questions, right? And by the way, guys, if I'm delivering value and you like this video, please also give it a big thumbs up, because honestly, it's the only way that Google knows that this content is relevant and makes my channel thrive. Awesome. So big thumbs up. Thank you. Let's move on. If in fact your file cash flows, what happens next? Well, check this out. In a commercial transaction, there are two pieces to the puzzle. One is doing the spreads, making sure that your file cash flows, and then pushing it over to underwriting, which would actually validate the work that the loan officer did. Similar to, if you were to do a residential deal, right? The loan broker would go through your tax returns, they would look at your liabilities, and they would basically say, yes, this person's proposed, liability, including the new mortgage, is less than 45% of their overall income. This file should work for whatever program you pick, right? It's a similar concept. So now the underwriter looks at it, validates the work of the loan officer, and says, yes, you know what? This fits the bucket. We will approve it. And now you get a loan commitment. When you get a loan commitment, something unique happens. It's time to order your third-party reports. Third-party reports are your appraisal, okay? Now, depending on the type of deal that it is, it may or may not need an environmental. That's a whole different conversation, which we're not going to get into. You're going to need a rate lock, because typically, and depending when, if the market's moving a lot like it is now, you want to make sure that by the time you're done with your transaction, the rate's not different and, your qualifying parameters are different. Rate locks could be good for 60 or 90 days. They all depend on the fee, right? Both are usually available. Now, what you want to do is you get your commitment and then you want to issue your deposit, because once you issue your deposit, the lender actually uses your money to pay for the third-party reports. And that's basically what the deposit is for. So any unused balance of your deposit gets credited towards your closing cost. Does that make sense? We got the commitment. The lender says, yes, I will lend you the money. Now, please hire these people, or we'll do it on your behalf, to make sure that all this information that is now not you, but the actual property, is in line with the kind of lending that we do, meaning that the value is there, meaning that your credit is okay, meaning that there's no contamination on the ground. We got to check all these things, and we got to pay third parties to do that, because that's not what we do for a living, right? those reports typically go out to bid, and then the most attractive bid gets presented and picked. And the turn time is usually around 3 weeks, plus minus. Once those reports are back, they still have to be analyzed internally. The lender has to look at them and say, you know what? They are in line with what we believe this property is worth, with our underwrite, and we are okay to move forward. If they see discrepancies, they will reach out back to the third parties, to discuss those discrepancies. So that process by itself takes about a week. So when people ask, how long do I need to close a transaction, a commercial transaction, typically the commitment could take anywhere between 2 weeks to a month. It really depends on how much you have going on. It depends when you're submitting your transaction. I can tell you that right now, because interest rates recently moved up, there's less activity, which is natural, right? I mean, there's still activity, but just less. So technically, deal flow goes a little bit quicker. If you did it a year ago, gosh, it would probably be a month before you get a commitment, right? And then another 3 weeks for reports, another week for review. That's, minimum 60 days. So I would say if you're going under contract, go in at 60 days just to be on the safe side, because 30 days, you'll get the file approved. Nowadays, probably a little bit quicker, maybe 3 weeks. And then from there, third-party reports another, 4 weeks or so. So you're all in about 7 weeks plus minus. Now, mind something else. Right now, we are in November 2022. Guess what? Next month and the end of this month, Thanksgiving, you have all the holidays coming up. So people are going to be out of the office a lot. You got to equate that, depending what your timeline looks like, got to make sure that people are available to work on your file. So anyways, that kind of puts everything in perspective. That's everything from A to Z. We covered a lot of ground. If you have any questions, reach out. And if there's anything, that you want to ask me, just put it in the comments below. I totally appreciate you guys watching this video. And, if you liked it, again, subscribe, thumbs up, do all that good stuff. I will catch you guys on the next video. Thank you and take care.